talk about financial news because the markets have seen some significant volatility in recent days, leaving many investors asking, where's the money? So here to help us make sense of all of this turbulence or not is Mark Henry from Alloy Wealth Management. And Mark is a regular friend of the Live Impact News stream here. Mark, how's it going this morning?
Fabulous today.
All right, so let's start with this big picture. What do you see as the primary drivers behind this news?
Well, you know, the question that's on everybody's mind is 26th the year that we see this big market pull down, draw down, crash, recession, whatever anybody wants to call it. It all means the same thing. Our portfolios, our money is gone or lower.
Right.
And so what's going on? Well, we have high valuations, and we've had it for quite some time. You know, Warren Buffett talked about it. The Buffett indicator, stock market cap to GDP, is at a near record high of 221%. The CAPE ratio is evaluated, seen historically high levels. Well, anytime when you think high evaluation, that means the business is valued higher, the stock is valued higher than maybe even the earnings are suggesting it should be worth. So we're seeing these high valuations, that's what they mean. Then we turn that into market volatility. So we're seeing a lot of, it goes up one day, it goes down the next. The other day it was down, then it went right back up. What in the world's going on there? And then we have economic uncertainty. So as I was driving over, and it was actually clear roads, and it felt not warm, but I wasn't freezing. I was like, this is kind of nice. I was thinking about what exact week in the last few years have we not had every one of those? Maybe the valuations weren't as high, but is there not economic uncertainty for the last 5 years of some kind or another? High inflation or this or that or jobs reports. We live in this world of information that has changed everything. And when I say it's changed everything, we can point to 10 different things that tell us the market's going to go down in 26, and I can find you another 10 or 15 that tell you it's going to go up.
Oh boy. So
what do you do?
How do you make sense of all of this?
How do you make sense of it? What can you do?
Yeah.
Time in the market. Let's stay with that. Stay invested. Stay invested in quality things. That's the great news. Now, should you be aggressive? I think if I was 70 years old and retired, I wouldn't want to be aggressive right now. I'd want to be much more diligent. I would want to have a bucket of money that would be aggressive. It's my long-term growth money to beat inflation with. But I wouldn't need it. When you say, what do you mean you wouldn't need it? I wouldn't need it today, because if I need it today, it shouldn't even be invested. If I need it the next 2 or 3 years, I shouldn't have it aggressively invested or even moderately invested. On the other side, if I'm young and working, why wouldn't I want to be in this market that's making money with all the vulnerability? Hey, it's still up. We're still making money. Why wouldn't I want to take part in that and grow wealth for one day to leave my legacy, for one day to retire and do the things I want to do in life?
Okay, so we hear these buzz terms, like you said, economic volatility and the uncertainty, rather. So if you're young, and what is young? 30s, 40s?
Yeah, I would say 20s, 30s, 40s, absolutely.
All right, so go ahead and just put it in your quality
go big.
market. Go big.
Yeah.
All right, go big, and then just, you know, I like to just kind of turn my back on it all.
Right. Just
and
don't
not
worry
look
about
at it.
Well, look at it for what it is. If the market takes a downturn, have a yard sale, get more money to go buy more good stuff on
That's one
sale.
way to look at it.
On sale.
On sale, okay.
Right. And now we're heading into that middle stage of life. Now we're starting to get into be more serious about how much we can afford to lose. And so we're having a good portion of our money not at risk, a portion of it that's just not at risk at all. Okay, and then we have a portion that's mildly invested, moderately, and then we still have aggressive long-term growth money that if it went down tomorrow a bunch, we just won't look at it.
All right.
But we have the other money that we could look at and know we didn't lose in.
Okay. All right. So it depends on where you are in life.
It is.
Are there particular sectors or areas where some are doing better than others, or where we should be looking at now?
Yeah, and so there's always that. There's 100% always something we could point to. But that's kind of like looking at, say, Bitcoin, cryptocurrency, a while back when it was over 100,000 a token or coin, and going, wow, I got to get some of that. But why aren't they looking at it today? If you're an aggressive investor and you want crypto, well, it's on its way down. I mean, who knows how low Bitcoin's going to go? It's hit the 70,000 number or somewhere in thereabouts. Why aren't we looking at it going, ooh, it's on the way down, maybe I should start buying it? But that's not how logic works. See, what happens is everybody wants what's hot. If it's already hot, you might be too late, like the tech sector right now, NVIDIA, all these other stocks, not giving anybody examples. But I'm just saying, think about all the things that are, quote, hot today. Where were you 2 years ago, 3 years ago?
Yeah.
This is where you build a good, solid portfolio by investing in quality items, and then you stay in the market. Not timing the market, in the market.
Okay. So if it's hot today, it's kind of like, well, it was hot a while ago. So not that you're too late.
Not at all.
But it's a little tricky if you want to time the market.
Right.
Okay, what do you tell your clients at this, when things get funky like this?
Well, so when you think about our clients, the ones we manage their money, they've already built it out in a way with a plan done by a certified financial planner. So they have their immediately available money. Market risk wouldn't have any to that whatsoever. They have their income plan where they're retired and they have income coming in, or maybe they're not retired and their income is their paycheck, so they're good there. They're saving toward retirement. They have their short-term money, they have their medium strategy money, and their long-term money. And so while none of us want to see a market downturn, it's inevitable. The question is when. I don't have a crystal ball for that, neither does anybody else, regardless of what they want to tell you.
Yeah, and that's when people ask, what should we be looking at?
Right. Who knows? So the idea is you can have peace and calm in your life when you build a confident financial future, not putting all your eggs in one basket, being diverse both inside Wall Street, which I love, and also outside of Wall Street. We have clients that have real estate portfolios, all different things. So the idea is it's your money. And so you're not looking to YouTube or anybody else to tell you what to do with your money. You're going to do it your way. But we have to do it in a way that makes sense so we don't have to panic if the market does go down tomorrow. We can do what you said. Don't look at it because we have other money that we can look at.
Right. That's the benefit of having a planner, I suppose. What is the sentiment, would you say, then, for American consumers, those working, able to pay themselves first? Is it a panic overall, or should people stay calm?
I think it's 100% you should stay calm if you've done the hard work and have a diverse portfolio. I don't mean diverse meaning all in one asset class. Diverse inside and outside, an emergency fund, a short-term bucket. And it's using bucket strategies. A lot of people use this, they don't understand it, but it's really simple. It's assigning a job to the dollars you have. You're being a good steward of your money when you clearly have a plan that you understand. You don't have to be an analyst, you don't have to be an advisor, but I know what this bucket's for. This is my 20-year from now bucket. This is my leave to the children bucket. I've already paid tax on it. It's a Roth. I'm going to be aggressive as heck because I don't care. I'm not using it for 20 years, and I want to see high growth. This money I'm going to start using in the next couple of years. I have a son going off to college. I have this or that. That money doesn't need to have any volatility in the markets.
Okay.
And you just build from one extreme to the other with different buckets. And you say, well, that takes a lot of money. No, it doesn't. I didn't tell you how much needs to be in each bucket. You can do this with short-term money. It could be enough, your emergency fund. Again, that's not going to be invested at all. But when you plan like this, it takes the fear away. Because what's the whole point of doing this if you're fearful the entire time? You're fearful as the market goes up because you don't want to see it go down. Market's going down. Now you're fearful because you're losing money.
Yeah.
We got to stop the chaos.
I don't understand how day traders can, do it every day, just even as a hobby. I mean,
Right.
I would be obsessed. All right, and then before all your buckets, that emergency fund is
Always first.
Always first.
Always first. Before you pay off the debt, before anything, you have to have an emergency fund. It's been my experience, you want to get out of debt, and the next thing you know, the time you get a couple credit cards paid off, you have an emergency. And with no emergency fund, guess what goes back on the credit card? The emergency. Can't do it that way. Emergency fund is always first.
All right. Mark Henry, anything else that we should know for today?
While I love the news, and there's so much good things that come out of the news, don't let fear be one of them. This is your life. It's your money. You control it. You be in charge of what you're going to do with your money.
All right. All right. We are proactive and we are going to be positive and not panicked through all of this. Thank you, Mark. Appreciate it.
Thanks for having me on.
Always.